You believe your bank stores your money. You walk into the branch. You hand over cash. You watch the teller type numbers into a computer. You leave with a receipt showing your balance. The money sits in a vault somewhere, protected, waiting for your return. This belief is false. Your bank does not store your money. Your bank does not have your money. The moment you deposit cash, it stops being yours. It becomes an entry on a spreadsheet, a number in a database, a promise written in digital ink. And here is what nobody taught you in school. When your bank issues a loan to someone else, it does not lend out your deposit. It creates brand new money, out of nothing, with a keystroke. This is not a conspiracy theory. This is not fringe economics. In 2014, the Bank of England published an official document admitting the entire process. The document states, whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. The German Bundesbank confirmed the same in 2017. The Federal Reserve published internal workbooks explaining the mechanism as early as 1961. Every major central bank in the Western world has acknowledged this system in official publications. Yet your economics textbook told a different story. Your professor described banks as intermediaries, middlemen who collect deposits from savers and lend them to borrowers. A simple transfer operation, money moving from point A to point B. The textbooks described a system of bottlenecks and constraints. Banks wait for deposits. Deposits enable loans. Loans move money through the economy, a clean, logical flow. The documented reality works in reverse. Banks do not wait for deposits to make loans. Banks create deposits by making loans. The act of lending generates new money. The borrower's debt becomes the economy's currency. This distinction separates those who understand financial leverage from those who remain its subjects. The families and institutions who designed this system became gatekeepers of money itself. They built infrastructure to concentrate wealth while convincing the public their savings sat safely in vaults. Welcome to Noob Historian. We follow the money, trace the power, and expose the history they never taught you in school. You live inside this system right now. The mortgage on your house exists because a bank typed numbers into an account. The bank did not take money from another customer and give it to you. The bank created new dollars at the moment of your signature. When the Federal Reserve printed $4.5 trillion after 2008 and another $4.8 trillion during COVID, citizens across America asked a simple question: where did this money come from? The answer? The same place commercial banks get their lending capacity. A ledger, an entry, a decision by someone with the authority to create currency. Your rent payments, your grocery bills, your shrinking purchasing power, all of these connect directly to a money creation system invented over 300 years ago by London goldsmiths, who understood a single truth. If nobody checks whether the money exists, you do not need to have it. This video traces the documented history of money creation from its origins in 17th century London through the founding of the Bank of England in 1694 to the present day. Every claim comes from primary sources: central bank publications, government reports, congressional testimony, peer-reviewed research. By the end, you will understand why debt always grows faster than the money supply, why housing prices outpace wages across decades, why every major economic crisis follows the same pattern, and why the official explanation always protects the same institutions. London in the 1640s operated on gold and silver coins. Merchants, traders, and wealthy citizens faced a practical problem. Where do you store physical metal when thieves and civil war threaten your wealth? Goldsmiths provided the answer. These craftsmen worked with precious metals daily. They maintained secure vaults. They employed guards. They offered storage services for a fee. A merchant would bring gold to a goldsmith. The goldsmith would weigh the metal, record the amount, and issue a receipt. The receipt stated the goldsmith held a specific quantity of gold payable to the bearer on demand. These receipts began circulating as money. Instead of withdrawing gold to make a purchase, merchants traded the receipts themselves. The paper was lighter. The paper was easier to divide. The paper carried the goldsmith's reputation as backing. Here, the system transformed. Goldsmiths noticed a pattern. Depositors rarely withdrew their gold simultaneously. On any given day, a small percentage of stored metal left the vaults. The rest sat untouched. This observation created an opportunity. If only 10% of depositors demanded gold at any moment, the goldsmith needed to keep only 10% in reserve. The remaining 90% of gold sat idle. Or did it? Goldsmiths began issuing receipts for gold they did not possess. A borrower would approach the goldsmith seeking funds. The goldsmith would write a receipt. The borrower would spend the receipt in the economy. The merchant receiving the receipt would treat it as money. No gold changed hands, no metal moved between vaults. The goldsmith created new purchasing power through written promises. This practice multiplied the money supply. If a goldsmith held 1,000 ounces of gold and issued receipts for 10,000 ounces, the economy now contained 10 times more money than actual metal existed. The goldsmith collected interest on loans backed by nothing but confidence. The system worked under one condition: depositors must never all demand their gold at once. If confidence held, the goldsmith grew wealthy. If confidence broke, the Goldsmith faced ruin. Modern banking calls this practice fractional reserve lending. The polite term obscures the mechanism. Banks hold a fraction of deposits and lend multiples of what they possess. By the 1660s, London Goldsmith bankers had refined the system into sophisticated operations. They accepted deposits, issued receipts, made loans, and created money with each transaction. The public believed their gold sat waiting in vaults. The goldsmiths knew the truth. The vaults held only a small percentage of their obligations. One goldsmith named Edward Backwell emerged as the largest private banker in England during this period. He financed King Charles II. He held deposits from nobility and merchants across Europe. His fortune grew from a single insight. Money is a confidence game, and confidence creates money. The goldsmiths faced occasional panics when too many depositors arrived at once. These runs exposed the gap between promises and reality. Goldsmith bankers collapsed. Depositors lost everything. Yet the overall system survived because the profits during stable periods exceeded the losses during crises. The English government watched this private money creation with interest. Here existed a mechanism to generate funds without direct taxation. Here existed a source of war financing beyond the king's treasury. The goldsmiths had built a machine the state wanted to control. In 1694, England faced a problem. William III needed money to fight France. Traditional borrowing had reached its limits. Tax revenues fell short. The treasury sat empty. A Scottish merchant named William Patterson proposed a solution. Create a new institution. Grant it a monopoly on certain banking functions. Give it authority to issue notes backed by government debt. Call it the Bank of England. This proposal transferred the goldsmith system from private hands to state-licensed operation. The government would gain access to created money. The bank would gain legal protection and privileged status. Together they would build the infrastructure of modern finance. On July 27, 1694, the Bank of England received its royal charter. The founding documents established something new in financial history, a permanent institution authorized to create money in partnership with the state. The original structure worked through a specific arrangement. Private investors contributed £1.2 million in gold and silver. This capital went directly to the government to fund the ongoing war against France. In exchange, the government paid 8% interest annually on the entire sum. The bank received a privilege worth more than any interest payment. It gained the right to issue banknotes equal to its capital base. These notes circulated as money. Merchants accepted them. Tax collectors received them. The notes carried the bank's promise to redeem them in gold on demand. Here, the goldsmith model achieved institutional form. The bank held £1.2 million in theoretical reserves. It issued £1.2 million in notes. The notes entered circulation as currency, but the original gold had already gone to the government. The bank's vaults held government IOUs, not metal. The notes represented claims on gold the bank had already spent. Yet the notes functioned as money because the government declared them acceptable for tax payments. This government backing substituted for actual reserves. Within years, the bank expanded its operations. It accepted private deposits. It made loans to merchants and nobility. It issued notes beyond its original capital base. Each expansion increased the money supply without increasing the gold stock. The founding charter contained a provision ensuring the bank's survival. If the bank suspended gold payments during a crisis, the government would protect it from legal consequences. This provision activated during the wars against Napoleon, when the bank stopped converting notes to gold for over 20 years between 1797 and 1821. During this restriction period, the bank's notes circulated without metal backing. The economy functioned, trade continued. The paper money retained value because everyone agreed to treat it as valuable. Gold had become irrelevant to daily commerce. The Bank of England demonstrated a principle modern central bankers still apply. Money derives its value from collective acceptance, not from underlying reserves. The psychology matters more than the metal. Throughout the 18th century, the bank refined its techniques. It learned to manage credit expansion and contraction. It developed relationships with smaller banks across England. It became the lender of last resort for institutions facing temporary shortages. This network created a hierarchy. The Bank of England sat at the top, creating base money through its note issuance. Provincial banks sat below, creating additional money through their lending operations. Each layer multiplied the money supply beyond the original gold reserves. By 1844, Parliament passed the Bank Charter Act in an attempt to restrict this multiplication. The act separated the bank into two departments. The issue department produced notes backed by gold, while the banking department handled deposits and loans. The reformers believed this division would prevent excessive money creation. They misunderstood the system they sought to control. The banking department continued creating money through deposits and loans. Checks and account transfers moved purchasing power without touching the issue department's note restrictions. The act failed to limit money creation because it regulated the wrong mechanism. Notes were visible and countable. Deposits were invisible and expandable. Banks shifted their money creation from paper to ledgers, and the expansion continued. This pattern repeats throughout monetary history. Reformers identify and restrict one form of money creation. Financial institutions develop alternative mechanisms outside the regulations. The underlying extraction power moves, but never disappears. The 20th century brought massive expansion of the money creation system and systematic efforts to hide its mechanics from public understanding. In the United States, the Federal Reserve System began operations in 1914. Its founding followed the Panic of 1907, when private banker J.P. Morgan personally organized a bailout of failing institutions. The crisis convinced Congress that America needed its own central bank. The Federal Reserve Act of 1913 created 12 regional reserve banks coordinated by a central board. The structure balanced public oversight with private bank ownership. Member banks held stock in their regional Federal Reserve branch. Private bankers sat on regional boards alongside government appointees. The Fed gained powers similar to the Bank of England. It issued currency, it set interest rates, it served as lender of last resort, it regulated member banks, and through all these functions, it shaped the money creation process. Commercial banks under the Federal Reserve System operated the same multiplication mechanism Goldsmiths had perfected centuries earlier. Banks accepted deposits. Banks made loans exceeding their deposits. Banks created money through lending. The Federal Reserve published internal documents explaining this process with surprising clarity. Modern Money Mechanics, a workbook distributed from 1961 through 1994, stated directly, of course, banks do not pay out loans from the money they receive as deposits. If they did this, no additional money would be created. Yet economics education in universities and high schools taught the opposite. Textbooks describe the money multiplier model where deposits enabled loans in a mechanical sequence. Banks appeared as passive intermediaries, shuffling existing money between savers and borrowers. This gap between official Fed publications and classroom instruction persisted for decades. The people who managed the system understood its true mechanics. The citizens who lived under the system learned a simplified fiction. Mariner Eccles, Federal Reserve Chairman from 1934 to 1948, testified before the House Banking Committee in 1941. A congressman asked where the Fed got the money for its operations. Eccles replied, "We created it." The congressman pressed, "Out of what?" Eccles answered, "Out of the right to issue credit money." He continued with a statement of extraordinary clarity. If there were no debts in our money system, there wouldn't be any money. This testimony sits in congressional archives. Anyone able to read it has access. Yet the statement's implications rarely appear in public discourse. If money comes from debt, then paying off all debts would eliminate all money. The system requires perpetual borrowing to function. Britain faced similar revelations. The Macmillan Committee, a parliamentary investigation into finance and industry, published its report in 1931. The committee included John Maynard Keynes, the most influential economist of the century. The Macmillan Report acknowledged the money creation process in official language. It is not unnatural to think of the deposits of a bank as being created by the public through the deposit of cash, representing either savings or amounts which are not for the time being required to meet expenditure. But the bulk of deposits arise out of the action of the banks themselves. This admission appeared in British parliamentary papers. The government's own investigation confirmed banks create deposits through lending, not the reverse. Yet the report generated little public understanding of its implications. Economics evolved during this period into increasingly mathematical and abstract formulations. Academic economists developed models treating money as neutral and banking as a veil over real economic activity. The actual mechanics of money creation disappeared behind equations and assumptions. By the 1990s, central bankers themselves began expressing frustration with academic economics. Mervyn King, later governor of the Bank of England, gave a 1994 lecture noting the divorce between monetary theory as taught in universities and monetary operations as practiced in central banks. The system remained stable enough to avoid triggering widespread public inquiry. Occasional banking crises caused localized damage. Inflation fluctuated with intolerable ranges in wealthy countries. The average citizen deposited money, paid bills, took loans, and never questioned the underlying architecture. This period of relative stability ended in 2008. In September 2008, Lehman Brothers collapsed. The fourth largest investment bank in America filed for bankruptcy. Within days, credit markets froze worldwide. Banks stopped lending to each other. The global financial system stood on the edge of total breakdown. The response revealed the money creation system to anyone paying attention. The Federal Reserve created over $1.2 trillion in new reserves within weeks. The Bank of England launched quantitative easing programs generating hundreds of billions of pounds. Central banks across Europe and Asia followed with their own creation events. Citizens asked the obvious question, where did this money come from? The federal government was broke, the budget ran deficits. How does a bankrupt institution create trillions of dollars? The answer forced central bankers into unusual honesty. In a 2009 interview, Fed Chairman Ben Bernanke explained the mechanism. We use the computer to mark up the size of the account. No tax revenue, no borrowing from foreign nations, no physical printing of currency. A computer entry created trillions of dollars. This admission circulated widely online. Financial commentators and citizen researchers began assembling the historical record. The Fed's own publications confirmed Bernanke's description. The Bank of England's technical papers detailed the same process. The system operated exactly as critics had claimed for decades. Then, in 2014, the Bank of England published a document designed to settle the debate permanently. Money creation in the modern economy appeared in the quarterly bulletin, the bank's official journal. The authors included members of the bank's Monetary Analysis Directorate. The paper stated without ambiguity, rather than banks receiving deposits when households save and then lending them out, bank lending creates deposits. In the modern economy, most money takes the form of bank deposits. But how those bank deposits are created is often misunderstood. The principal way is through commercial banks making loans. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. The Bank of England specifically contradicted the textbook model. This description of how money is created differs from the story found in some economics textbooks. Germany's Bundesbank issued similar confirmation in 2017. The monthly report stated, banks create book money by making an accounting entry. This refutes a popular misconception that banks act as intermediaries at the time of lending, meaning banks grant credit using funds placed with them previously as deposits by other customers. These official publications transformed decades of conspiracy theory into documented central bank admissions. The evidence no longer required independent research or alternative sources. The institutions themselves confirmed the mechanism. Professor Richard Werner of the University of Southampton conducted the first empirical test of money creation in 2014. He borrowed 200,000 euros from a small German cooperative bank, Raiffeisenbank Wildenberg, and tracked the internal accounting with the bank's cooperation. Werner's peer-reviewed paper, published in the International Review of Financial Analysis, documented exactly what central banks had admitted. The bank did not transfer existing funds to create his loan. The bank created a new deposit entry in his account. Fresh money appeared at the moment of lending. This empirical confirmation closed any remaining academic debate. The credit creation theory was not theory, it was observed and documented fact. The 2008 crisis also revealed the fragility hiding behind the creation mechanism. Bank-created money exists only as accounting entries. When confidence collapses, those entries evaporate. In March 2023, Silicon Valley Bank demonstrated this fragility in spectacular fashion. SVB held deposits exceeding $175 billion. Within 48 hours, customers withdrew $42 billion. The bank collapsed. Federal regulators seized the institution. Where did those deposits go? They vanished. The money existed because a bank had created it through lending and accounting. When the bank failed, the accounting entries became worthless claims. Only federal intervention, guaranteeing all deposits beyond the insured limit, prevented cascading bank runs across the regional banking sector. SVB's collapse illustrated a core truth about bank-created money. It depends entirely on confidence. The dollars in your bank account exist because everyone agrees they exist. The moment agreement breaks, the dollars disappear. Understanding money creation transforms your view of current economic debates. Every policy discussion about inflation, housing, debt, and currency involves this mechanism. Between 2020 and 2022, the Federal Reserve created approximately $4.8 trillion through quantitative easing and emergency lending programs. Commercial banks simultaneously expanded lending, creating additional trillions in new deposits. The M2 money supply, tracking cash and bank deposits, increased by over 40% in 2 years. This money entered circulation as purchasing power. Families received stimulus checks drawn on newly created Fed reserves. Businesses accessed loans backed by Fed facilities. Asset prices surged as the new money sought returns. When inflation followed, official explanations focused on supply chains and consumer demand. These factors contributed. But the fundamental driver remained the same mechanism Goldsmiths found in the 1600s. Creating money without creating corresponding goods and services reduces the purchasing power of existing money. Your salary stayed flat while housing prices doubled in many markets. Your savings account paid near zero interest while asset holders watched their portfolios expand. The newly created money flowed upward through the financial system, concentrating gains among those closest to the point of creation. This distribution pattern has a name, the Cantillon effect. Richard Cantillon, an 18th century economist, observed that newly created money does not enter the economy evenly. Those who receive it first spend it at current prices. Those who receive it last face prices already raised by earlier spending. Banks and their direct borrowers sit closest to money creation. They access new purchasing power before prices adjust. Workers paid in wages sit farthest from creation. They face adjusted prices without accessing the new money. Central bank digital currencies represent the first potential structural change to this system since 1694. CBDCs would give central banks direct relationships with citizens, bypassing commercial bank money creation entirely. The Federal Reserve, European Central Bank, and Bank of England all research CBDC implementation. China already pilots a digital yuan in several cities. The design choices embedded in these systems will shape monetary architecture for generations. If a CBDC replaces bank deposits, commercial banks lose their money creation privilege. Central banks gain direct control over every transaction in the economy. The pressure points of monetary authority would shift from distributed private banks to concentrated state control. Cryptocurrency emerged as one response to the 2008 revelations. Satoshi Nakamoto, the pseudonymous creator of Bitcoin, embedded a message in the first block mined on January 3, 2009. The message quoted a Times of London headline, "Chancellor on brink of second bailout for banks." This reference signaled Bitcoin's purpose as an alternative to bank-created money. Bitcoin has a fixed supply schedule. No institution creates new Bitcoin through lending. The system operates through mathematical rules rather than institutional discretion. Whether Bitcoin or other cryptocurrencies succeed as money remains uncertain. Their volatility undermines their function as stable stores of value or units of account. But their existence forces monetary authorities to compete with alternatives for the first time in centuries. The documented history of money creation reveals a consistent pattern. Control flows to those who manage the creation mechanism. Goldsmiths became wealthy by issuing receipts for gold they lacked. The Bank of England became untouchable by partnering with state authority. Commercial banks became essential infrastructure by making themselves too connected to fail. Your participation in the system is not optional. Every dollar you earn, spend, save, or borrow passes through institutions, operating the same mechanism London goldsmiths refined over 3 centuries ago. The mortgage on your home created money at signing. Your credit card creates money with each purchase. The national debt creates money as government bonds become bank reserves. Debt and money are inseparable in this architecture. This inseparability explains why debt levels grow faster than the money supply. Interest accrues on every loan, but banks create only the principal, not the interest. The economy must continuously expand borrowing to generate the money needed to service existing debts. Critics call this a Ponzi scheme requiring infinite growth to avoid collapse. Defenders call it a flexible system adapting to economic needs. Both describe the same mechanism from different positions. The Bank of England's 2014 paper ends with a revealing admission. In the modern economy, central banks implement monetary policy by choosing the price of reserves, meaning interest rates, rather than controlling the quantity of reserves. Central banks do not control how much money banks create. They set the price of borrowing and watch commercial banks respond. The actual money creation happens in private institutions, for private profit, creating purchasing power from accounting entries. When Mariner Eccles told Congress in 1941 that money comes from the right to issue credit, he described a privilege more valuable than any gold reserve. The right to create money is the right to create claims on future production. Banks exercise this right daily, earning interest on money they created through bookkeeping. The next crisis will follow the same pattern. Bank-created money will expand during good times, inflating asset prices and funding consumption. Confidence will break over some trigger. The money will contract as loans default and deposits vanish. Central banks will create reserves to prevent collapse. The cycle will reset at a higher debt level. Understanding this pattern does not make you immune to its effects, but it positions you to recognize official explanations for what they conceal. When authorities describe inflation as mysterious or unavoidable, you will know its connection to money creation. When they describe banking crises as unpredictable shocks, you will know the fragility built into fractional reserves. The system continues because enough people benefit from its operation and enough people remain ignorant of its mechanics. Central bankers who manage the system rarely discuss its foundations publicly. Commercial bankers who profit from creation rarely advertise their privilege. Politicians who depend on created money for spending rarely explain the costs to their constituents. 300 years of monetary history point toward a single conclusion. Money is not a thing you earn and store. Money is a relationship of credit and debt, managed by institutions granted special privileges, operating mechanisms deliberately obscured from those who use the currency daily. The goldsmith who first issued a receipt for gold he lacked found something fundamental about human psychology. We prefer convenient fictions to inconvenient investigations. We accept paper promises without checking vault contents. We trust institutions without understanding their operations. This trust enables the modern economy to function. It also enables the modern economy to concentrate wealth among those who create money and distribute costs among those who earn it. Now you understand the system. What you do with this understanding remains your choice.